Tax advantages of incorporation, the Canadian corporate perspective. Optimizing legally permissible tax structuring begins with understanding the tax-driven benefits of incorporating and operating as a corporation. If you are operating a business in Canada as a sole proprietor or through an unincorporated partnership, every single dollar of net income your business generates flows directly onto your personal T1 income tax return in the year it is earned. In Canada, our progressive personal tax system means that as your business succeeds and your earnings rise, your tax burden escalates rapidly. Depending on your province of residence, top personal marginal tax rates kick in at relatively modest income thresholds and quickly climb into the 48% to 54% range. That means more than half of your upper-tier business profit is redirected straight to personal income taxes right away, leaving you with less working capital to reinvest, hire staff, or manage cash flow. Incorporating your business fundamentally alters this dynamic by establishing a separate legal entity under provincial or federal corporate law. From a tax standpoint, this legal separation introduces one of the most powerful wealth-building tools available to Canadian entrepreneurs: corporate tax deferral. When your business operates through a corporation, the profits generated belong to the corporation, not to you personally. If you do not require all of those profits to pay for immediate personal living expenses, you are under no obligation to withdraw them. Instead, you can leave those funds inside the corporate entity where they are taxed at significantly lower corporate tax rates rather than your personal marginal rate. This leaves a vastly larger pool of capital inside the business to purchase inventory, acquire capital assets, expand operations, or build up an emergency reserve. To understand how dramatic this corporate tax deferral can be, we need to look at the Canadian-controlled private corporation, or CCPC framework, and the small business deduction. Under the Federal Income Tax Act, a qualifying CCPC enjoys a preferential federal tax rate of just 9% on its first $500,000 of active business income each year. Active business income refers to profits generated from operational activities, such as providing professional services, selling goods, or contracting, as opposed to passive investment returns. Each province then adds its own small business corporate tax rate to that federal baseline, creating distinct jurisdictional advantages. Let us look first at Alberta. Alberta maintains one of the most competitive corporate tax environments in North America, applying a provincial small business rate of just 2%. When combined with the 9% federal rate, an Alberta corporation pays a combined tax rate of only 11% on its first $500,000 of active business income each year. Now consider Ontario. Ontario reduced its provincial small business rate to a competitive 2.2% on active income up to a $600,000 provincial business limit. Combined with the federal rate, an Ontario corporation pays an effective tax rate of 11.2% on its small business profits. When you place an 11% corporate tax rate in Alberta or an 11.2% corporate tax rate in Ontario side by side with top personal tax brackets that exceed 48% in Alberta and 53% in Ontario, the financial impact becomes immediately clear. By retaining active profits inside your corporation, you achieve an immediate tax deferral advantage of roughly 35% to 40% on every dollar kept in the business. That retained capital acts as an interest-free loan from the government, allowing your business to compound its growth far faster than would ever be possible as a sole proprietor. The third major tax advantage of incorporation is total control over your personal remuneration structure and income timing. As an unincorporated business owner, you are taxed on 100% of your net profit in the year it is earned, regardless of whether you spent that money or left it sitting in your business bank account. As a corporate owner-manager, you dictate precisely how, when, and in what form you receive personal compensation. Canadian corporate taxation allows you to draw income using a tailored mix of T4 salary and T5 dividends. Paying yourself a formal salary represents a tax-deductible expense for the corporation, which reduces the company's taxable income dollar for dollar. On a personal level, receiving a salary creates earned income, which builds valuable registered retirement savings plan, or RRSP, contribution room, and allows you to participate in the Canada Pension Plan. Alternatively, you can choose to pay yourself non-eligible or eligible dividends out of the corporation's after-tax profits. Dividends are not deductible by the corporation, but they flow to you personally subject to the dividend tax credit system, which accounts for the corporate tax the business has already paid. This integration mechanism aims to ensure that total taxes paid corporate plus personal, are roughly equivalent whether you choose salary or dividends, while giving you the strategic freedom to select the payout method that best aligns with your personal tax situation. Beyond choosing between salary and dividends, incorporation grants you the power of multi-year income smoothing. If your business experiences a banner year and generates exceptionally high profits, you do not have to take that income personally and spike into the highest personal tax bracket. You can retain those profits inside the corporation and pay yourself a steady, controlled salary or dividend over several years. You can even defer withdrawals until lower income years or until retirement, effectively controlling your personal tax brackets over your entire lifetime. The tax advantages of incorporation are not limited to ongoing operations. They extend directly into your long-term exit strategy, wealth preservation, and business succession. When you operate as a sole proprietor, selling your business typically involves an asset sale, where individual assets, goodwill, and inventory are sold. This often triggers immediate personal income tax and fully taxable recapture on capital cost allowance. In contrast, operating through a corporation enables you to sell the actual shares of your business. Individual Canadian taxpayers who sell qualifying shares of a qualified small business corporation, or QSBC, can access the Lifetime Capital Gains Exemption. This statutory exemption allows eligible shareholders to shelter a substantial capital gain completely tax-free upon the disposition of their shares. To qualify for this exemption, your corporation must meet strict statutory asset tests under the Income Tax Act. For instance, at the time of sale, at least 90% of the fair market value of the corporation's assets must be used primarily in an active business carried on in Canada. Furthermore, throughout the 24 months preceding the sale, more than 50% of the assets must have been devoted to active business operations, and the shares must have been owned by you or a related person. Sole proprietorship simply cannot access this exemption because there are no corporate shares to transfer. Additionally, a corporate structure provides access to advanced tax-deferred reorganization tools under the Income Tax Act. Utilizing a Section 85 rollover allows you to transfer personally held assets, real estate, or proprietary intellectual property into a corporation in exchange for shares without triggering an immediate taxable event. Furthermore, mature businesses can execute a corporate estate freeze, locking in the current value of the business for the founding shareholder while issuing new growth shares to family members or key employees. This effectively shifts future capital gains tax liabilities to the next generation while maintaining control of the enterprise. To summarize, incorporating a business in Canada delivers 4 major structural tax advantages: immediate access to low corporate tax rates on active business income, up to $500,000, such as 11% in Alberta or 11.2% in Ontario; significant corporate tax deferral on retained earnings; complete flexibility over salary and dividend remuneration planning; and long-term capital gains protection through the Lifetime Capital Gains Exemption and corporate reorganizations. However, it is crucial to recognize that incorporation is not a one-size-fits-all solution, nor is it a passive substitute for proper financial management. Operating a corporation introduces ongoing legal, accounting, and statutory compliance obligations. You must file separate annual corporate T2 returns, maintain official corporate minute books, prepare resolutions, and file annual provincial corporate updates. Furthermore, failing to properly structure your initial share capital, mismanaging active versus passive income rules, or ignoring shareholder loan rules can lead to severe tax penalties, unexpected personal tax exposure, and the loss of your small business deduction or capital gains exemption. Before executing an incorporation or restructuring your current operations, you should work directly with experienced corporate legal counsel and tax professionals to ensure your legal framework is built correctly from day one. To learn more about our legal practice of business incorporations and corporate legal work, visit our website and contact our law firm to schedule an initial consultation. Thank you.